Our next reading is Introduction to Fixed Income Valuation. These are specific learning outcome statements which have been split into 5 areas of studies: bond valuation and yield to maturity, spot rate and accrued interest, yield measures, yield curves, and finally yield spread. The key areas that we will cover in this reading are the factors that determine the value of debt securities, various yield measures, yield to maturity, spot rates, forward rates, and finally yield spread measures. So let's do each LOS one by one. First LOS says calculate a bond price given a market discount rate. The market discount rate that is suitable for or appropriate for discounting a bond's cash flow is also called bond's yield to maturity or redemption yield. Now we have been given an example and we'll try to understand this learning outcome statement through this specific question. Consider a newly issued 10-year $1,000 par value 10% coupon annual bond. The coupon payments will be $100, that is 10% of 1,000 at the end of each year. The 1,000 par value will be paid at the end of year 10. Now let us calculate the present value of the bond or the bond value when the relevant market discount rate is either 10%, 8%, and 12%. Alright, so for part A we have 10 periods. Relevant discount rate is 10%, 10. Then we have regular payment of coupon 100, since it's a payment, negative. And the future value, the value, redemption value of the bond is 1,000, and this will be given negative as well. Now if you press CPT PV, it's exactly $1,000. Why? Because our coupon is same as the discount rate. Whenever the coupon and the discount rate are the same, the face value is the value of the bond. FV means face value, par value, the selling price at the end of an assumed holding period. So now let us try this for the next part B when the relevant discount rate is 8. 10 periods. Now the interest rate relevant is for discounting purpose is 8. The payment is 100 negative PMT. FV is 1000 FV, and then press CPT PV. It's 1134.20. Now since your coupon is more than the yield to maturity or the relevant market discount rate, you are giving more interest than the market discount rate, so the bond will sell at a premium. So an important conclusion that we can draw from this computation, that when the market discount rate is lower than the coupon, the bond will sell at a premium, and this number is 1134. That's the value at which the bond will sell. So when bond yield decreases from 10 to 8, the present value of a bond payment, its market value increases, as you can see from this computation. Now let us do the same thing for part C when the market discount rate is 12%. 10 periods, relevant discount rate is 12%, coupon payments 100 negative PMT, FV is 1000 negative, and press CPT and present value is 886.99, which is approximately $887. This is the present value of the bond. Now if the market discount rate, as you can see, if it's 12%, the bond will sell at a discount. Why? Because your coupon is lower than the market rate, so the bond will sell at a discount of about $113. So when the bond yield increases from 10 to 12, as you can see, the present value of bond payments, its market value decreases. So this nicely sums up this LOS, calculate bond price given a market discount rate. We will also do an example when the coupon payments are not annual. When the coupon payments are semi-annual, then in that case, how do we calculate the price of the bond? That is our next example we'll be doing shortly. Now consider a newly issued 10-year 1000 par value 10% coupon semi-annual pay bond. And the market discount rate is 8%. Now we need to calculate the value or the price of this bond. In order to find the price of a semi-annual pay bond, we need to divide the coupon by 2. So the coupon will be 10 by 2, 5%, that is $50 every 6 months. So that's the one thing you will do. Second, you will multiply the overall term of the bond with 2. So if it's 10 years, a newly issued one, 10 times 2, so the number of periods would be 20. And you will do the same thing what you did with the coupon. You divided coupon with 2, 5%. You will divide the discount rate by 2 as well. So it's going to be 4%. Now, what you will do in your TVM computations, N is 20. FV is 1000. The regular coupon payments are $50 each every 6 months. And the discount rate or interest rate per period, that's going to be 4%. So in case of a semi-annual pay bond, our N will be 10 times 2, 20. The discount rate will be 8% upon 2, that is 4. Our interest payments, coupon payments will be $50 every 6 months, 50 with the negative sign as your payment, and your FV, the par, would be 1000, negative at maturity. Right? Just press CPT and present value. So the price of the bond will be 1135.90 in case if it's a semi-annual coupon bond. Now the third case, if it's a zero coupon bond, then how we will calculate the price of a zero coupon bond? We'll do it in a minute. All right. Second, clear TVM. Consider a newly issued 10-year 1000 par value, zero coupon bond. When the market discount rate is 8%, what is the price of this bond? So what you will do, 10 as your periods. There is no payment, 0. PMT 0. The future value, the par value, the redemption value at maturity is 1000 FV, right? The discount rate is 8. Simply press CPT and PV. Now this will give you the price of the bond. So a 10 years, $1,000 par value, zero coupon bond, when the discount rate is 8%, the price of this bond as of now will be $463.19. So this completes your LOS calculate a bond's price given a market discount rate. Your next LOS is identify the relationship among a bond's price, coupon rate, maturity, and market discount rate, yield to maturity. So let us discuss these one by one. First, relationship between price and yield. This is what we discussed in our previous LOS. You would have noticed that when we increase the yield to maturity, the price of the bond falls, and when the yield to maturity is decreased, the price goes up. That we just discussed a little while ago. So that's a very straightforward, understandable relationship. Now next, coupon rate and YTM. Now this again is related to our previous LOS. We just saw in the previous LOS that when the coupon rate is greater than YTM, that is the relevant discount rate for bond valuation. So when the coupon rate is greater than the yield to maturity, the bond will sell at a premium to par. And conversely speaking, when the coupon rate is less than yield to maturity, the bond will sell at a discount. Next, change in price of the bond with change in YTM. Okay, now if the YTM increases, increase in YTM will cause the price of the bond to fall. And when YTM decreases, the price of the bond would increase. Now the price yield convexity suggests that the percentage decrease in price of the bond when the YTM increases, the decrease is a lower percentage compared to when the YTM decreases, the increase in price would have a higher percentage. Next, price and coupon rate. Now let us assume a bond that has a high coupon rate, let's say 8%. A bond with high coupon rate, it is less sensitive to changes in YTM. Comparatively, a bond with the low coupon rate, let's say 3%, this bond would be more sensitive to changes in YTM. So we can say that the price of the bond with high coupon rate, it is less sensitive to changes in YTM compared to the bond that has a low coupon rate. The bond with a low coupon rate, it will be more sensitive to changes in YTM. Next, the relationship between price and maturity. So a bond with a long-term maturity, let's say 15 years, the price of this bond would be more sensitive to changes in YTM compared to a bond that has a shorter maturity, let's say 3 years. So this bond, which has a maturity of 3 years, it will be less sensitive to changes in yields. So these were the relationships that we were required to identify and interpret in this specific LOS. Now let's say a bond that has a coupon rate of 6%, and if YTM is also 6%, the bond will trade at par and will be redeemed at 1,000. Now, if the same bond with coupon 6%, when the market rate or the YTM is 12%, in such a case, the bond will sell at a discount, and this discount will be amortized, and the price of the bond will converge to the par by the bond matures. And in this case, if the coupon rate is 6%, YTM is 3, the bond will sell at a premium. This premium will be amortized over the period, and the bond price will converge to the par at the date of maturity. This can be simplified in this way: a premium bond, premium to par, it will converge to par at maturity. A bond at discount will again converge to par at maturity. So this convergence to par value at maturity is called as what you call the constant yield price trajectory. Constant yield price trajectory. Now it shows that how the bond price would change from 185 to 1000 and 852 to 1000, how the bond price would change as time passes if its yield to maturity remained constant. That's why it's called constant yield price trajectory. Our next LOS is define spot rates and calculate the price of a bond using spot rates. So far we have used yield to maturity as a discount rate for discounting the bonds, the cash flows related to bonds. In reality, discount rates depend on the time period in which the bond payment, the cash related to bond payment will be made. So what are spot rates? Spot rates are the market discount rates for a single payment to be received in the future. Like for example, we have a zero coupon bond maturing in 1 year. So the discount rate for this zero coupon bond maturing in 1 year, let's say it's 3%. Another zero coupon bond maturing in 2 years, let's say it has a discount rate of 4%. And another zero coupon bond maturing in 3 years, it has discount rate of 5%. So the discount rates for zero coupon bonds are spot rates, and we sometimes refer to spot rates as zero coupon rates or simply zero rates. Now let us try to apply this idea. Given the following spot rates or zero rates or zero coupon rates, calculate the value of a 3-year 5% annual coupon bond. Okay. So the relevant cash flows for year 1, 2, and 3. First, there will be 3 coupon payments of 50, 50, and 50. And then the principal payment at the end of year 3. So the total payments, the cash flows for year 1, 2, and 3 are given as 50, 50, and 150. Now we need to discount these at the relevant zero rates or zero coupon rates. So we will discount this $50 cash flow at the end of year 1 at 3%. So it's going to be 1.03 raised to the power 1 plus this $50 second year interest payment. It will be discounted at next rate 4%. So it's going to be 1.04 squared plus 1050, that is the interest plus principal, will be discounted at the third year's zero rate. That will be 1.05 raised to the power 3. So if you calculate their present values, it will give you $1001.80. This is the price of the bond. So this price that we have calculated, this has been calculated using the zero rates or the spot rates. This price is also called the no arbitrage price of a bond. Because if a bond is priced differently, investors will make profit from arbitrage among bonds. So that's why it's called no arbitrage price. If you just see that the price of the bond is 1001.80 more than the par, so which means that the YTM would be less than 5%. If you plug in the numbers in your financial calculator, N3, the coupon payments PMT 50, FV 1000, PV negative 1001.80, and if you simply compute YTM, interest per period, you will calculate it at 4.93. So this shows that the YTM is less than the coupon. That's the reason the bond is selling at premium. So next reading is define spot rates and calculate the price of a bond using spot rates. This is the definition. Spot rates are the market discount rates for a single payment to be received in the future. So basically the discount rates for zero coupon bonds are spot rates, and we sometimes refer to spot rates as zero coupon rates or sometimes simply zero rates. So let us try to grasp the idea through the help of an example. A 3-year bond offers 10% coupon rate with the interest paid annually. Assuming the following sequence of spot rates, the price of the bond is closest to. So this is the discount rate for use for year 1, 2, and 3 years cash flows. So how we'd find the present value? The coupon is 10, year 1, year 2, and the last year will involve interest and the principal. So we need to discount them at these rates: 1.08 for the first year, 1.09 for the second year, and 1.095 cube for the third year. If you do the computations, it will be $9.26 plus 8.42 plus $83.78. So this will give you the price of the bond to be $101.46, and that's B. So this is how you can find the price of the bond using spot rates. Your next LOS is describe and calculate the flat price, accrued interest, and the full price of a bond. The coupon bond values we have calculated so far are calculated on the date coupon is paid. Basically, we have so far calculated the present value of the remaining coupon payments. For most bonds trades, the settlement date, what's the settlement date? The date at which when cash is exchanged for the bonds. So this settlement date will fall between the coupon payment dates. as time passes and future coupon payments dates gets closer, the value of the bond will increase. So this value of the bond that goes up as the coupon payments become closer because of the interest earned over the period. Like for example, a 5% bond makes coupon payments on June 15th and December 15th and is trading with a YTM of 4%. Now, the bond is purchased and will settle on 21st of August. So the last coupon payment date was June 15th and the next coupon payment date would be December 15th, right? Now the bond is purchased and will settle on August 21, right? Now we need to calculate the price of the bond at this date. At this date, not only you will receive the future discounted coupon payments, but also this much interest earned over the period from 15th of June till 21st of August. So what is full price then? Full price is the present value of the future cash flows from the last coupon date plus the interest earned till the settlement date. Let us calculate this. That will enhance your understanding. So first step you should do is to calculate the value of the bond from the last coupon date from June 15th. So since there are 4 coupon payments remaining, so N is 4. It's a semi-annual bond, interest payments on June 15th and December 15th. So then it means that the rate we will use for discounting purpose will be 4/2, that is 2%. The FV is 1000 and payments are 5% upon 2, that is 2.5, so the payments are 2.5. So using these conventions, these inputs in our TVM, we can calculate the present value. When you punch in these numbers, the present value will come as 1019.04. Now this is the present value at this date. Present value at this date. We just need to incorporate the interest earned over this period, and this can be done using this formula. The full price is equal to present value, which we've just calculated, multiplied by 1 plus R% raised to the power T upon capital T. This small t represents the days from the last coupon payment till the settlement date, and this large T represents the days between one coupon payment to another. So in our example, the number of days from 15th of June till August 21, the small t, that is going to be, if you calculate the number of days, it's going to be 67 days. And the total days from June 15 to December 15, the actual days would be 183. Since we were required to use the actual days, so the actual days from June 15 to August 21st and the actual days from June 15 to December 15. So this will give you, so let us plug in the number. It will give you the full price 1019.04, 1.02 YTM, and raised to the power 67 upon 183. Sometimes we use a convention 30 by 180. Normally, in order to use a single number of days for each month, we use 360 approach. So in this case, from June 15th onwards to December 15th, we will assume that every month has 30 days and there are 360 days in a year. So that is 360 approach. So it depends upon the kind of question that you are asked. So you just plug in these numbers in your calculator. So you will calculate your full price as 1026.46. This is called full price. And please note, when I wrote 2.5, that was 2.5 of par, so it was basically $25. So $25 negative FV will give you the PV of 119.04. Okay, next, accrued interest. Accrued interest is the interest earned between the last coupon date and the date when the bond is sold or bought. So accrued interest can be calculated simply by multiplying the regular coupon payment 25 into T upon T. This small t is the time between June 15 to August 21, that is 67, and the capital T is June 15 to December 15, that is 183 we use. Multiply this with 25. So it's $9.15. Now, this is the full price and this is the accrued interest. Then what is the flat price? The flat price is equal to full price less accrued interest. This flat price sometimes is also called the clean price. Your next LOS is define matrix pricing. What is matrix pricing? When we have to value a bond that is not actively traded, or maybe it is not traded at all. The process by which the price of a not actively traded fixed rate bond can be determined using the market characteristics of a comparable bond. So how do we value such a bond? What we do, the YTMs of the comparable bonds are determined using their quoted prices and coupon rates. The comparable bonds mean the bonds having the same characteristic as this bond, maybe the same ratings. So the YTM of these bonds can be used to calculate an average through interpolation, and then we can use that market rate to value this not actively traded bond. Let's take an example. Assume that an analyst needs to value a 4-year 5% annual coupon payment bond, bond K, which is not actively traded. So we are not sure about its price. What we can do, the analyst could find some other bonds with the same comparability, however, with a comparable credit quality. There are two bonds. We have selected bond L, bond M. Bond L is a 3-year 5.5% annual coupon bond and currently priced at 108. The bond M, a 5-year bond with 4.5 annual coupon payment, is priced at 105. What we do, we calculate their YTMs. The YTM for the first bond is 2.69 and YTM for the second bond is 3.4. Since the coupon payments 4.5, 5.5, 5% falls exactly in between these two numbers. So we will simply take the average of these two YTMs. 2.69 plus 3.4 upon 2 gives you 3.045%. Now we will use this market discount rate to find the value of not actively traded bond. With a market rate of 3.045%, all that remaining is discount the bond's payments to determine the price. So what are this bond has a coupon of 5%, means $5 for $5 for these 4 years, plus this 100 par value discounted at this market rate will give you the present value of these coupons plus the present value of principal. So the total will be 107.26. So this will be the price of this so-called not actively traded bond. So this is how we can use the matrix pricing to determine the price of the bonds that are not actively traded. So next LOS is calculate annual yield on a bond for varying compounding periods in a year. And let's consider a 5-year annual pay 7% bond that is priced in the market at 120.78. The YTM will satisfy this equation, or else we can use our TVM computations in our financial calculator. We will plug in N as 5, PMT 70, FE 1000, PVs, and then we can calculate our yield to maturity. Now, for a 5-year semi-annual 7% coupon bond, see, the maturity is the same, coupon payments are the same, but it's a semi-annual pay bond. We can calculate the semi-annual discount rate as YTM by 2 and then double it to get the YTM expressed as an annual yield. How we do that? We'll multiply. We have done many questions like these. 5 is times 2, 10. The coupon payment will be 7% of par, that is 70 upon 2, 35. The face value is 1000, PV is 1000. This is the current price we just discussed a little while ago. And then by using the TVM computations, the yield will be 3.253%. And then we can simply, since it's on semi-annual basis, so you need to multiply it with 2 to get 6.506. Now, this is how we can compound periods in a year. Let's say had it been a quarterly bond, so we would have done it at 40. This would have been 17.5. Same, and then the result would have come and we would have multiplied it with 4 to get the annual yield. So this is how we can use the varying compounding periods, and that's how we can find the annual yield based upon the frequency of interest payments. And this frequency of interest payment is also called the periodicity of a bond. A bond with a periodicity of 1 makes an interest payment once a year. A bond with a periodicity of 2 will have 2 yearly payments. A periodicity of 4 will have the 4 payments of a coupon in 1 year. So for any coupon rate, the greater the periodicity, the more compounding periods, and hence the greater the annual yield.